Hello everyone and welcome. With the new Income Tax Act of 2025 on the horizon, getting a solid grip on its core concepts is more important than ever. Today, we're going to decode one of the most fundamental terms you'll come across, actual cost. Trust me, getting this right is the bedrock for everything from calculating depreciation to figuring out capital gains. Okay, let's dive right in. So, just imagine this for a second. It's the tax year 2026-27, your business is growing, and you've just invested in some brand new machinery. The big question is, how do you correctly figure out its actual cost for your tax filings under this new act? Now, this isn't just some textbook question, right? This has a very real impact on your tax liability.
Here's what we've got lined up. We'll start by defining what actual cost really means under the new law. Then we'll get into the nitty-gritty of the calculation itself, before walking through a practical, real-world example. After that, we'll talk about the crucial compliance checks you need to know, and we'll wrap up with the key takeaways you'll want to remember.
So, what is actual cost? Well, to put it simply, it's the official value of an asset that the tax authorities will recognize when you're calculating deductions. You can think of it as the foundation for your depreciation allowances, and it also plays a huge role in figuring out your capital gains or losses when you eventually sell that asset. Getting this number wrong from the start can cause some serious headaches down the road. Now, let's take a look at the law itself. As we move from the old 1961 Act to the new 2025 Act, you'll be glad to know there's a good deal of consistency. The main idea behind actual cost hasn't been completely turned on its head. If anything, it's just been clarified and streamlined for the new tax regime. What's really striking here is the continuity. Under the old Section 43(1), the principle was pretty clear. The actual cost is what the asset actually cost you. The new 2025 Act carries this idea forward, but with one key emphasis. Your own books of account are now the official starting point. This really shows how the new Act is focused on aligning your tax calculations with your audited financial statements.
So here it is, the formal definition. The actual cost begins with the value you've recorded in your company's books. But, and this is the really crucial part, that book value is just the beginning. It has to be adjusted based on very specific rules laid out in the 2025 Act. So, let's see how that calculation actually works.
All right, this is where the rubber meets the road. We're going to get into the nuts and bolts of what you add to the cost and, just as importantly, what you absolutely must subtract. It's a bit of a game of additions and subtractions to get to that final correct number. The Act itself gives us our starting block. This quote right here confirms that for a new business, the whole journey begins with the cost shown in your books on the very last day of the tax year you kicked things off. This basically makes your accounting records the primary source of truth for the tax authorities. This table lays it all out perfectly. On the left, we have all the costs you must include. You start with the purchase price, of course. Then you add any cost to get the asset to your location and ready for use. Things like freight, installation charges, and any non-refundable taxes. Now on the right, you've got the exclusions. If the government gives you a subsidy for that asset, that amount has to be deducted. The logic here is pretty simple. It's to prevent a double benefit. You can't get a subsidy and also claim a tax deduction on the money you never actually spent. The same goes if someone else pays for a part of the asset. And notice that last point, revenue expenditure. That means you can't include ongoing costs like an annual maintenance contract. Those are regular expenses, not part of the asset's capital cost. The whole point is to isolate the true capital costs that you incurred to get that asset up and running. Okay, theory is one thing, but let's see how this all works in practice. We're going to take all these rules and apply them to a simple, real-world scenario to make it crystal clear. All right, let's walk through this together. Your business buys a piece of machinery for 10 lakh rupees. That's our base cost. Then you spend 50,000 on installation and pay 1,80,000 in non-refundable GST. Both of these are essential costs to get the asset working, so we add them in. That brings our total up to 12,30,000. But then you receive a government subsidy of 2 lakh rupees, specifically for this purchase. We have to subtract this amount. So the final actual cost for the purpose of claiming depreciation is 10,30,000 rupees. It's this final number, not the initial purchase price, that you'll use in your depreciation schedule. See how that works?
Knowing how to do the math is half the battle. The other half is making sure you're compliant and avoiding those common mistakes that could get you into hot water with the tax department. So let's look at how to get it right. Here's your essential checklist. A detailed fixed asset register, that's non-negotiable. You have to keep every single supporting document to back up each cost component. We're talking invoices, receipts, transport bills, the whole lot. Your tax computations must tie back perfectly to your accounting records. And critically, make sure you properly document any grants and clearly separate your one-time capital costs from your regular, day-to-day revenue expenses.
And on the flip side, here are the major pitfalls to watch out for. A big one is improperly capitalizing costs, like adding routine maintenance charges to the asset's value when it should be a yearly expense. Another common mistake is just forgetting to deduct a subsidy. That's a huge red flag for tax officers. And finally, just plain old poor record keeping, from weak documentation to a mismatch between your tax filings and your books, can easily lead to adjustments and penalties.
Phew! We've covered a lot of ground. So, let's boil everything down into a few key takeaways to make sure the most important concepts really stick.
To sum it all up, first, actual cost is the starting point for both depreciation and capital gains. Second, under the 2025 Act, the value in your books of account is king. Third, the fundamental ideas from the old 1961 Act are still very much alive, so your existing knowledge is still incredibly valuable. And finally, meticulous documentation isn't just good practice. For compliance, it's an absolute necessity.
And that brings us to our final thought. As we head into this new tax era, the question you should really be asking yourself and your team is this: are our asset accounting and documentation processes robust enough to meet the standards of the Income Tax Act 2025?
Thank you for watching. If you found this explanation helpful, please go ahead and give it a like, subscribe to our channel, and be sure to share it with your colleagues.
This presentation is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational resource.